Hello everyone. Headline news lately in global market about 10-year US Treasury notes yield soared to 5%. This is the first time since 2007. Before that, we would like to invite everyone to like and subscribe the Trading Kids YouTube channel. Your real-life access in global market and macroeconomics. For today's video, we will tackle important informations about 10-year US Treasury notes and the implications of the soaring the Treasury yield in global market. And of course, the impact to every investor in global market. The headline: the 10-year Treasury tops key 5% level once again. Hear what that means for you. Stock market news October 18, 2023, S&P 500 closes lower. Treasury yield climb above 4.9%. Though future tumbled 200 points on Monday as 10-year Treasury yield tops 5%. The 10-year Treasury yield soared to 5%. The 10-year Treasury yield has surged to 5%, a level unseen since 2007. This shift impacts both Wall Street and Main Street. It signifies a rapid rise from the pandemic's low of 0.50%, leading to increased government borrowing costs. Moreover, it ripples through the global financial system, affecting loans, investment, and even employment prospects. After prolonged period of low interest rates, central banks are now focused on curbing inflation by raising rates, potentially changing the economic landscape. This is a 10-year US Treasury notes yield chart from November 2022 to October 2023. Chart shows that there is a significant rise of yield from November 2022 to October 2023, just a matter of 1 year. Before we alarm about the rising of yield and its impact, please get to know first what is a 10-year US Treasury note that we are talking about. A 10-year US Treasury note, a bond that guarantees interest plus repayment of the borrowed money in a decade. The 10-year Treasury is just one of the handful of securities issued by the US government. Others include treasury bills, also known as T-bills, are short-term securities with maturities that range from a few days to 52 weeks. Treasury bills are sold at a discount to their face value, meaning they provide investors with return by paying them back at the full, not discounted rate. Treasury notes, also known as T notes, are issued with maturities of 2, 3, 5, 7, and 10 years. They pay interest every 6 months and return their face value at maturity. Treasury bonds, or also known as T bonds, are the longest term government securities issued for 20 and 30 years. They pay interest every 6 months and return their face value at maturity. So the federal government offers fixed income securities to consumers and investors to fund its operation, including treasury bonds, treasury notes, and treasury bills. Treasuries are that instrument in which investors are lending the US government the purchase amount of bonds. In return, investors are paid interest or a rate of return. When the bond matures or maturity date, investors are paid the face value of the bond. Did you know Treasury bond yields are tracked by investors for many reasons? The yields are paid by the US government as interest for borrowing money by selling the bond. The 10-year Treasury yield is closely watched as an indicator of broader investor confidence because Treasury bonds, along with bills and notes, carry the full backing of the US government. They are viewed as one of the safest investments. The 10-year T-note is the most closely watched government bond. It is used as a benchmark rate for banks to calculate mortgage rates. Typically, the 10-year note is in high demand since it often used as a safe haven investment to reduce the volatility in an investment portfolio. During times of recessions and market uncertainty, the demand for the 10-year can increase significantly, leading to fluctuation in bond prices and yields. Conversely, during economic expansion, investors may sell their 10-year notes and offer higher yielding bonds since there is a reduced risk of loss during expansionary business cycle. However, the 10-year is extremely popular with institutional and retail investors as well as central banks and governments. As a result, there is a healthy, steady demand for the 10-year note, providing an ample liquidity. The jump means the rise in the 10-year Treasury yield most directly means the US government has to pay more to borrow money from investors for 10 years. Here are the impact of soaring Treasury notes yield. The 10-year Treasury yield serves as a vital economic benchmark and it influences many other interest rates. When the 10-year yield goes up, so do mortgage rate and other borrowing rates. When the 10-year yield declines and mortgage rates fall, the housing market strengthens, which in turn has a positive impact on economic growth in the economy. The 10-year Treasury yield also impacts the rate at which companies can borrow money. When the 10-year yield is high, companies will face more expensive borrowing costs that may reduce their ability to engage in the types of projects that lead to growth and innovation. The 10-year Treasury yield can also impact the stock market, with movement and yield creating volatility. Rising yield may signal the investors are looking for higher return investment, but could also spook investors who fear that the rising rates could draw capital away from the stock market. Falling yields suggest that corporate borrowing rates will also decline, making it easier for companies to borrow and expand, thus giving equities a boost. Global events can also have a significant impact on treasury yields, like the case of the UK referendum about EU membership mentioned above. US government bonds are considered the safest investment anywhere in the world, and when geopolitical events create upheaval, treasuries are often in high demand from international investors, leading to lower yields. The impact of soaring treasury yield for the consumer like you. For the American consumer who power the US economy, an elevated 10-year treasury return means more costly car loans, credit card rates, and even student debt. It also means more expensive mortgage rates. US mortgage rate this week hit highest level in 21 years and home affordability is now at its lowest level in several decades. High yield and global market. More immediately because a 10-year treasury is seen as one of the safest possible investment on the planet, it yields swiftly sway prices for all kinds of investment. When a super safe treasury is paying much more in interest, investors feel less need to pay high prices for big tech stocks, cryptocurrency, or other investment that carries more risk. It's a big reason the S&P 500 has seen its gain for the year so far tumble from 19.5% at the end of July to 10% as of Friday. Higher US yields also attract more investment from abroad, which means investors are increasingly swapping their currencies for US dollars. Since the end of July, the US dollar has climbed roughly 4% against the euro, 5% against the British pound, and 6% against the Australian dollar. Higher bond yields could bad news for stock. Bonds compete with stocks for investor dollar and equities go down. That's because if bonds are yielding more than stocks, the bonds are generally more attractive. After all, treasuries are backed up by US government, stocks is not. That makes the riskier. Tech stock often suffer most because those companies typically take on a lot of debt to fund their growth, leaving them particularly vulnerable to rising borrowing costs. A US dollar tend to benefit when yield rise. When the dollar gets stronger, stocks generally suffer. Stronger dollar can reduce the value of companies' foreign earnings and make US export more expensive to consumer abroad, potentially hurting corporate profits and share price. Reason why US Treasury Notes yield is rising. There are four cited reasons why 10-year US Treasury yields rising. Number one, increased US Treasury debt issuance. Number two, Bank of Japan monetary policy. Number three, a robust US economy. And number four, a higher inflation premium. Increased US Treasury debt issuance. On July 31, the US Treasury surprised the bond market when it announced a significantly larger need to raise money than expected. The US government now anticipates raising a net $1.007 trillion through bond sales in the third quarter, the largest cash raise ever during the third quarter, some 25% more than it estimated it would need just a few months ago. This announcement was followed days later by rating agency Fitch lowering the US government credit rating to AA plus from AAA, citing a deteriorating fiscal outlook. While bond investors largely shrugged off the downgrade, it came as prices were being pushed lower to adjust for higher issuance. Bank of Japan monetary policy. For decades, one constant of the global landscape has been Japan's extremely low interest rates. As the Bank of Japan has struggled to assimilate the country's moribund economy, it has kept bond market yield locked at close to zero. One side effect of this policy has been that Japanese investors have turned to foreign bond market in search of yields, mostly United States and Europe. However, just 2 days before the Treasury announcement, the Bank of Japan surprised investors by raising its cap on bond yields to 1% from 0.5%. While monetary policy changes in Japan move glacially, according to Mark Lindblom, portfolio manager at Western Asset Management, the speculation in the market is about whether the Bank of Japan will continue to notch the cap higher, making the market more appealing to Japanese investors. He says that concern that if Japanese investors have their own bonds they can buy, they're going to repatriate the capital, won't buy as many as US treasuries, and that's going to push long term rates up around the world. A robust US economy. Just about the biggest unexpected development this year has been the continued strength of the US economy. Defying widespread expectation for a recession, consumer spending remains solid, and while job growth has been moderating, hiring continues at a historically strong pace. This resiliency has come despite the regional banking crisis in March, which had many worried about credit crunch that could lead to bank lending stalling out, taking the economy into a downturn. The US economy surged at its fastest pace in nearly 2 years last quarter, with GDP growing at annualized rate of 4.9%. Consumer spending also spiked by 4%, the highest since 2021, while core inflation moderated to its slowest rate since 2020. Despite the growth, the Federal Reserve is raising the interest rates to potential inflation rates. A higher inflation premium. Against this backdrop, bond investors are looking for a little more cautions in long term yields against the possibility that inflation may remain elevated. Inflation premium is defined here as the higher return that investors demand in exchange for investing in a long term security, where inflation has a greater potential to reduce the real return. Inflation is a bond's worst enemy. Inflation erodes the purchasing power of bonds' future cash flow. Typically, bonds are fixed rate investment. So if inflation is increasing, the return on the bond is reduced in real terms, meaning adjusted for inflation. For example, if a bond pay a 4% yield and inflation is 3%, the bond's real rate of return is 1%. So, in other words, the higher the current rate of inflation and the higher the expected future rates of inflation, the higher the yields will rise across the yield curve, as investors will demand a higher yield to compensate for inflation rates risk. I would like to share the special report made by COL Financial about long-term bond yield rising. For COL Financial client like me, you may find this report at COL Research tab. And for non-COL Financial client, this portion is definitely worth to watch. Reason why the latest increase in bond rates is worrisome. Number one, higher risk of defaults, weaker economic growth. So this is the most obvious risk that comes from higher interest rates. It discourages consumers and businesses from borrowing and spending, and it increases defaults from borrowers who cannot afford to pay the higher cost of debts. Higher rates would have a negative impact on economic growth, increasing the risk of a recession or hard landing in the US. Number two, lower stock prices. Analysts use longer term band rates in valuing stocks. As the 10-year band rate goes up, the present value of future earnings goes down, leading to lower stock values. Moreover, the prices of stocks must go down to improve their competitiveness against bonds that now provide much higher yields. Higher rates are particularly worrisome in the US as stocks are expensive. So with the S&P 500 index still trading at par with its historical average PE multiple, higher rates coupled with expensive valuations make US stocks more vulnerable to a sell-off. Number three, higher rates lead by longer term bands. The increase in band rates during the past few months was led by longer term bands. Although the 2-year band rate is up by 31 basis points since the end of June, the increase is much less than the 101 basis point increase in the 10-year band rates and the 106 basis points increase in the 30-year band rate. Number four, significant decline in bond values. The price of bonds is inversely related to interest rates. Higher interest rates means lower bond prices. So moreover, the prices of longer term bonds are more sensitive to rising rates compared to short term bonds. Consequently, the recent increase in interest rates would lead to a significant losses for bond investors, especially those that bought a large amount of longer term bonds in the past thinking that interest rate would stay low, including banks. According to the US Federal Deposit Insurance Corporation's US bank were sitting on unrealized losses in their securities portfolio amounting to 558.4 billion US dollar in the second quarter. With a significant increase in bond rates since end June, these losses should now be even bigger. Number five, possible margin call. Because of the steep rise in band rates, fund employing leverage strategies could suffer from a margin call. So what this happened, funds will have no choice but to indiscriminately sell bonds in their portfolio. So this could lead to a vicious cycle as forced liquidations would lead to higher band rates, a further decline in band prices, and more selling from funds suffering from a margin call. Number six, harbinger of an upcoming recessions and bear market in stocks. In 2001 and 2007, longer term band rates increased after the yield curve initially inverted. These were shortly followed by a recession in a bear market. So some analysts are worried that the ongoing increase in longer term band rates and the resulting stiffening of the yield curve are warning signs of a fast approaching recession and bear market in the US. So if US stocks enter a bear market, Philippine stocks could also go down. So this as the Philippines has always suffered from a contagion during past bear market. Okay, what should stock market investors do? From COL Financial CoLingShots, the bad news that comes with rising long-term band rates dated October 23, 2023. Okay, given the numerous risks facing equity market both in the US and the Philippines, there is a greater chance that local stocks will remain weak in the short term. So as such, we continue to recommend maintaining some cash and staying underweight in stocks. However, investors should still prepare mentally to deploy extra cash if local stocks are sold off due to contagion triggered by a US recession and a stiff decline in S&P 500. Although US stocks have significant room to go down, Philippine stocks should go down less since we are already at the late stage of a bear market or the no interest space. The no interest space is characterized by low trading volume and stocks trading a very cheap valuation. Note that average daily value turnover in the PSE has dropped to only 5.6 billion peso for the year-to-date period from 6.9 billion in 2021 and 6.4 billion in 2022. In fact, there are some days now when value turnover is less than 4.0 billion peso. Philippine stocks are also very cheap with PSI index trading at only 10.9 times PE, more than two standard deviations below its 10-year historical average PE multiple of 16.3 times. The main drawback of buying stocks during the no interest phase is that it can last for a long time. So to manage your risk, only use long-term money or funds that you are sure that you will not need in the near term to buy stocks. So doing this will enable you to ride out the volatility. Also focus on blue chips that pay cash dividend so that you are paid to wait. Most importantly, constant remind yourself that your patience will significantly rewarded when the Philippines finally enters a bull market in the future. After all, stocks would not trade at such a low valuations if not for the bear market. What should stock market investors do to trading kids recommendations? So in PH stock market, buy an index stocks with a medium term time frame. Sell when the bull market came, as you observe most of the index stocks hit or near 52 weeks low. As of writing, PSI is currently at the 6,000 level. Further, practice, monitor, and study the stock performance during the bear market and how it goes up when the market enters into bull territory. So these are the stock market index stocks with current price, 52 weeks low price, and 52 weeks high price.